Good morning. Welcome to the second quarter and first half 2021 financial results presentation of the Photon Energy Group. We'll be presenting to you. I'll be presenting to you together with our CFO, Clemens Wohlmuth.
Good morning.
Good morning. Thank you very much for finding the time. And today we will start off with a brief overview of our business model, particularly to those investors who are new to our call, which after the capital increase, we believe there are some among you. We'll also briefly touch on the strategic partnerships that are important for our further development. We'll talk briefly about strategy and outlook, and Clemens will run you through the financials both for the second quarter and the first half of 2021. So on the business model, Photon Energy is a company that we established in 2008. We are a company headquartered in the Netherlands with activities in more than 10 countries. And we have grown our headcount to over 140 employees worldwide. Our shares are publicly traded on the regulated market in Warsaw, the regulated market in the Czech Republic on the Prague Stock Exchange, and the open market of the Frankfurt Stock Exchange, and linked to that also on some of the regional exchanges in Germany, where we have also our corporate bond traded on the Frankfurt Stock Exchange and the regional exchanges. One of the milestones that we implemented in the second quarter of this year is that we have completed the process of obtaining a sustainability rating in cooperation with the German certification company IMUG. Given our line of business, or our two lines of business, energy and water, of course, sustainability is at the core of what we do, and getting this rating is a logical step, and of course is also very important in our communication with capital markets, but also will play a significant role in our further financing activities, both on the equity and the debt side. Just a few key points on our solar business line. So we have so far built over 110 megawatts, the majority of which for our proprietary portfolio, which currently stands at 89.3 megawatts after the commissioning of our two plants in Australia with a combined installed capacity of 14.6. In our O&M division, we take care of over 300 megawatts of power plants. That includes, of course, our proprietary portfolio, but also external customers. And a key activity, more on that later, is project development. So our project pipeline currently stands at almost 550 megawatts. And in terms of electricity production from our portfolio, in 2020, we generated over 70 gigawatt hours. And this year, with increased capacity, we will exceed the 100 gigawatt hour mark materially. On our water business line, we have several activities where on the lake management side, we currently manage around 600 hectares. We have so far, for our water utility clients, conclude projects with for over 3,500 meters of wells, where we drilled new ones or we regenerated old ones. And then, of course, we have our patent pending groundwater remediation technology, which we have already applied for various types of contaminants. But the most promising area is remediating PFAS contamination, where we have a pilot project running in Australia again, more on that a little bit later. So looking at our business model on the solar side, from the very beginning of our activities, we've always focused on covering the entire life cycle of PV plants, looking at financially covering the entire value chain of PV projects slash power plants. So at the beginning of everything is always project development, which in the markets where we operate, we organize in-house. So we're always trying to develop projects from scratch ourselves, but we also cooperate with external developers with whom we typically team up at various stages of the project development, bring it to the ready-to-build stage, and then take over those projects to be built and added to our proprietary portfolio. We are also providing EPC solutions. This has been mainly concentrated in the Australian market in recent years, where we have concluded several on-grid but also off-grid installations, which also include battery storage solutions. Our goal, and it's already happening this year, but particularly in the next several years, we want to be more involved in providing external EPC solutions to corporate clients in particular. In our technology business, we are leveraging our procurement process for the construction of our own PV plants and EPC business, and resell key components, which is modules, inverters historically, but this year we've also been adding battery components, and that will probably get further expanded. And we're also in the process of adding mounting structures, particularly for rooftop installations. There, our client base are installation companies that typically serve customers that are below our focus. So, as mentioned above, we typically start around 300 kilowatts, particularly for rooftops. So most of our installation clients serve customers that are that require smaller installations than that. In this area, we're currently working on launching a B2B web shop, which we expect to launch at the beginning of the fourth quarter, which should further automate processes and of course increase our business. It is a very important business line, not only because it makes money, but also it keeps us in constant contact and we're constant off-takers and customers of the component suppliers, which, talking about modules, are among the top 5 manufacturers in the world. So we are a more attractive customer for them, as we are not only buying stochastically within the project, but on a constant basis. And of course, very important is investments on the back of our project development. And our approach is that we only invest into power plants that we have developed and built ourselves. So we are very strongly focused on building power plants that are designed and built with the best available technology at the time. And as our investment horizon is essentially forever, we are trying to make sure that these power plants will operate smoothly for the 25 to 30 years as expected. So our strategy is not to buy existing assets from other developers, but at the same time, unless we exit the market, a geographic market, we are also not selling existing power plants. This may become an option if our project development churns out more than our own financing capacity allows. So given the progress we are making, particularly in some of the Central European markets, it may become a feature, but the core is always to keep adding and growing our proprietary portfolio and generate the recurring revenue streams from operating PV assets. Last and definitely not least is operations and maintenance, which again is of utmost importance for us to ensure that our assets operate most efficiently and generate and meet or ideally exceed the forecast production to maximize uptime, that we repair problems as quickly as possible. But again, this is an area which we are leveraging to external customers, and with 12 years experience in this field, we see a lot of growth opportunities, particularly in the region of Central and Eastern Europe, where in some of the markets that have recently started or are now restarting growth in their installed capacity, we are among the very few experienced O&M providers with a track record, with our own monitoring software, and again, the ability to really provide with in-house expertise a complete suite of services to ensure maximum performance of the assets owned by our customers. Moving on to our water business, which we have been developing over the last 4 years. We are involved in providing water treatment solutions for various types of settings. So for providing drinking water, but also to prepare water for technical use of corporate customers. The next area is wells and resources, where our customers are primarily water utilities, and there again, the major focus is on wells, where again we are providing services across the life cycle of water wells, so from drilling new ones, regeneration after typically 25 to 40 years of use, and in some cases also decommissioning. The next area is water resource management, which focuses on surface waters and like lakes and ponds, and there we have a particular focus on providing solutions as a service to fight the blue-green algae bloom, which with rising temperatures during the summer has become an issue globally and has negative impact on the use of surface waters for recreational use, but it also poses challenges, or rather is poisonous, where water is used as drinking water. So there our customers are both water utilities, but very often the authorities or very often municipalities that are in charge of water bodies. Our approach is we want to provide solutions where we're trying to combine external technology or sometimes external components, but in order to be able to provide end-to-end solutions, we of course need to do some research and development. And one of the areas which has gotten a lot of attention on our R&D is remediation, where we have our own proprietary and now patent pending technology to remediate groundwater. We have done several projects in those 4 years for various types of chemical contamination, but the big one and most promising is in the area of PFAS chemical contamination. The market that is most advanced in addressing this, the threats from PFAS chemicals is Australia. So the regulatory framework there is the most strict, and this is also the market where we have a pilot project at the moment. And we are in a situation where we have a technology that obviously works on various contaminants, and after having been informed by our colleagues in Australia some 2.5 years ago, about the issue of PFAS and the regulatory response. We conducted several hundreds of reactor tests, which proved that in a reactor setting we can break down PFAS chemicals, and at the moment there is no technology that can break down these chemicals, which are very stable, they don't degrade in nature, sometimes also referred to as the forever chemicals. And so we've had very encouraging results, and last year we signed an agreement with the Australian Department of Defence, and in one of the Air Force bases, Jervis Bay, we signed an agreement to decontaminate the entire land, but currently still in the pilot phase, and we should inject the reactive material in the next couple of weeks and expect results within a few months from that onward. This is a highly visible project in the global remediation industry, and we believe that those results will be positive and will open the doors for hopefully the full project in Jervis Bay, but then additional projects with the Department of Defence in Australia, in the Australian market, where we have already identified several other project opportunities. But PFAS contamination is a global problem. The second most developed markets in terms of regulatory frameworks is North America, but also in Europe we see the EU Commission, but also national regulatory bodies waking up to this issue. And for example, the Netherlands and Denmark are at the moment at the forefront. So there'll also be project opportunities in Europe over time, and of course we are working on some of them. To conclude this section, again, just a quick overview of our footprint. So we're headquartered in Amsterdam, but most of our activities take place in the 4 Visegrad countries plus Romania. But for some of our services, we have customers all over continental Europe. As mentioned before, our current pipeline is almost 550 megawatts. Some of it in Australia, the rest spread across Hungary, Poland, and Romania. And we also see some action now in the Czech market, and we also believe that the Slovak market at some point will again become more attractive for solar investments. So our electricity production portfolio consists of 11 plants in the Czech Republic, where we have 15 megawatts of installed capacity. Those plants were built in 2009 and 10. We have 10.5 megawatts in Slovakia. Those plants were built in 2010 and 11. And over the last 3 years, we built 49.1 megawatts in Hungary, and with 3 installations in Australia with a total of 14.7 megawatts. And in the area of O&M, we stand above 300 megawatts, and that includes full service O&M, but we're also providing specialized technical services for PV inverters across Europe. We have our own monitoring software, and we're constantly trying to adapt to the needs of our customers by adding new services and features. Just briefly, this on our strategic cooperation. So that we have made a minority investment in Lerta, which is a Polish company that started out as a developer of software that can run and operate a virtual power plant. And on the back of the last financing round, they're going to the direction of operating in the energy market. We've really gained access. We've become a player in the capacity market in Poland, which in the region is the most developed. But they're also working on energy trading licenses in Poland, but in close cooperation with us. Also in the process of entering the Hungarian and the Romanian market, possibly, and also the other two in the region where we operate. And our goal is to cooperate very closely in accessing the energy market, and in that providing us also with balancing services for our growing portfolio across the region. So plus we are also cooperating on the development of behind the meter solutions, where we install PV equipment on warehouses, factories, or near them, and provide corporate off-takers with electricity. And these plants are ultimately also grid connected, and there's typically also an excess production that goes to the grid, which needs to be handled by a licensed trader. So there are various levels of cooperation, and this is a very important not only investment but also strategic partnership for the implementation of our business model. And the second investment that we've made initially in April 2020, and we also now participated in the follow-on financing round, is Raygen Technologies in Australia. So this is, as our business model is purely on the downstream side, this is our first foray and investment on the upstream side of the total solar value chain. What got us to do that is that Raygen, as the first company operating and providing and developing technologies in the areas of concentrated solar, have managed to combine concentrated solar, as it is standardly known, with PV production. So what is new is that they have managed to develop a PV cell that can be placed in the receiver. That means in the place where the reflection from the mirror field is reflected. So it can be placed there. The cells withstand the high temperatures. We're talking about from 7 to 750 degrees Celsius, so that the sunlight can be used twice. So it's used instantly to produce electricity through those cells, but as in traditional concentrated solar projects, the heat is also captured. And the other innovation is the thermal hydro storage system, where the heat is channeled and concentrated in a hyper-insulated hot water pool, whereas the electricity that has been produced through the PV cells is used to run chillers that cool water in a second hyper-insulated pool. So in the cold pool, the water temperature is around 5 degrees Celsius, whereas in the hot water pool it's kept just below the boiling point, between 90 and 95. And then when electricity is needed from the heat difference through an organic Rankine cycle engine, which is essentially a low pressure steam turbine, electricity is produced. This system can run in an island setting. So, for example, to provide electricity to a remote location like a mine or a remote village, but it also works, of course, connected to the grid, and can also provide grid support services on top of the electricity. This system is highly efficient, and it allows to store energy for extended period of times. One of the limitations of batteries is that both technically but also financially, they still do not make sense whenever the production or the consumption of the supply needs to be shifted by more than 4 to 5 hours. Here we can, with minimal losses, store the energy even for weeks and months, but definitely in a 24-hour setting, this is a very efficient solution. And What we do see more and more, looking at the pricing curves in Australia, but also other markets, and also here now in Central Europe, is that the so-called duck curve is becoming ever more visible. That means that electricity prices are high in the morning and the evening, and relatively low during the day as the share of renewable generating assets in the network grows. And that's mostly coming from solar, as solar on a sunny day produces most around midday. So historically, and Poland is actually, the Polish market now is a very good example, where until 6 months ago, there was still a premium price during the day, around midday. That premium has disappeared, and now very, very slowly we are moving into the direction where some of the Western European energy markets already are today, that energy prices are actually lowest at the time as a lot of renewable energy enters the grid. Therefore, electricity in the morning and the evening hours is much more valuable, and in Australia that is also very, very visible. Sometimes there are actually even negative prices during the day, but very high prices in the morning and evening. So this technology will allow to operate very efficiently in a situation where we produce during the day, store the energy, and then supply when the prices are the highest. But the system is also capable of turning, if that's what's requested, the intermittent production from solar into 24-hour stable base load. So it provides at a very cost competitive level energy when it is needed most and when it's most valuable. From now on, we have decided that all our project development in Australia will be for projects using the radiant technology, and we're also looking at other markets. And as the components become cheaper, and actually energy prices are growing, and the duck curve is becoming more pronounced, also in the Central European region where we operate, we may also start developing projects for this technology in the next couple of years. Looking ahead, and going through our strategy, the cornerstone has always been and will continue being expanding our portfolio of power plants by developing those projects in-house with maximum control. So we're not dependent on buying projects that others have developed, very often for technical solutions that we don't want to employ. And I think here we're currently in a situation where, particularly based on the change in the pricing structure, it is obvious that single axis tracking is the way to go, because we are getting from single axis tracking we're getting first of all higher specific production, but significantly higher production in the morning and the evening hours, and more evenly spread throughout the day. So as the duck curve becomes more pronounced, the production profile from single axis tracking is going to be much more valuable. And we see that in some markets, and actually Poland is a prime example, pretty much all the development that's happening at this point in time is for fixed technology. So it's very difficult for us to actually go out and acquire projects, and this is why the focus at the moment is very much on developing in-house with the technical solution that we want to deploy going forward. And of course, we are developing all our projects also in the other markets on tracking technology. So this connection between development and then the implementation and the investment, having that all in an integrated process is definitely a key strategic advantage. As mentioned before, we want to develop our EPC activities going forward in those areas where we can turn our expertise into adequate margins. EPC of traditional PV plants has in many markets become a commodity, so it's rather difficult to generate margins that justify the risk that stemming from warranties we have to provide. So we are trying to develop this business in those areas where we can where we face smaller competition that are less of a commodity, and of course going forward it's more and more hybrid installations, including storage, where we have our expertise, where we have very good references, particularly from Australia, and that's the area where we want to grow. On the back of our own investments and the expansion of our portfolio, I think here we should also repeat our already communicated strategic goal to expand our portfolio from the current 89 megawatts to 600 megawatts by the end of 2024. So that will also drive, of course, our O&M business just on the back of our own portfolio development. We, of course, are also working hard on making progress in winning external customers, but of course also our EPC customers in the majority of cases we will provide with O&M services. And to conclude, and as I mentioned before, we are now investing also into our technology distribution business, as we believe that with now very dynamically growing installation volumes in the markets where we operate, there's significant growth potential in providing the technology that the installation companies require. In the water business, remediation is definitely the one area where we have the highest potential to scale quickly, and that includes, of course, PFAS, which has a global application. But as I mentioned before, our technology works for various types of contaminants, and also there we are chasing additional projects. And essentially, we're using the same technology. So a lot of growth potential there. Of course, also in the other segments, we believe that and we see significant growth opportunities with respect to lake management, with water resources, and of course also the water treatment solutions. So to conclude, before I hand over to Clemens for the quarterly, just a quick overview of our project development activities. So as you can see, we have made some nice progress between the end of the first quarter and particularly measured against the end of last year in Poland. So we've managed to add to the 67.5 we had at the end of Q1, and we currently stand at 93 megawatts, and we're putting a lot of resources behind our project development effort. We have a very capable and dedicated team that identifies suitable land. We have a team of land seekers that goes out, and our team, of course, is then also very capable in handling all the permitting processes. So that number, we believe, will further grow materially until the end of this year. And of course, this is a long-term exercise, so we will just keep developing as long as there's potential in the market. With the finite resource, of course, being grid capacity, it is a very competitive market. But we are finding we have a system in place where we believe that we'll be able to keep developing every quarter several dozens of megawatts. In Hungary, we are currently in a situation where we are mainly focusing on pushing along the project development of and permitting of projects that we already have in the pipeline. So we have very close to 100 megawatts, but also there we believe that that we'll be able to identify additional opportunities in the next couple of quarters. In Romania, which is a market that is now of particular interest and very attractive due to the high energy prices, we have what we believe to be already a very nice and substantial pipeline of almost 200 megawatts. There again, now the focus is on getting as many of those projects ready to build next year. So there's several projects that will start construction as soon as weather permits after the winter. But we of course also trying to identify additional project opportunities, so we also expect that number to grow in the next couple of quarters. And last but not least, we have Australia, where after the asset swap with Canadian Solar, we ended up with Merriwale, our majority stake, a 65% stake in Merriwale, and which already has the construction permit. We're still working on the grid connection parameters and agreements, and there at this point in time, obviously all options are open, ranging from following through with the project, but also the potential sale to a third party. And here we'd like to just repeat again that from now on, all our project development in Australia will be based on RayGen technology. And on that front, we believe that in the next couple of months, we will see also our first footsteps and first couple of locations that we'll hopefully be able to add to our project pipeline. So I will hand over to Clemens to run you through the financials.
Thank you very much, George. Once again, good morning. Hello from my side as well. I will guide you quickly through the quarterly and half-year figures. Before I do that, I want to recap with you just briefly what happened over the last 6, respectively 3 months, the key highlights. As you might know, when you have followed us already throughout the year, at the end of Q1, we commissioned and finalized our very interesting hybrid project in Australia for Lord Howe Island, where we installed PV and battery solution. We have done, George mentioned it already, in Australia, for our large-scale projects, we did a swap of project rights with Canadian Solar, our co-development partner, and decided to basically increase our share on the Merriwale project, which we, as mentioned, will continue developing now. We have increased our share in RayGen resources in this technology company in Australia as well, which is also visible then later in our investments on the asset side and cash flow. Very important to mention in Q2, the end of Q2, we have placed some of our treasury shares on the market and raised equity in the amount of 7.7 million euro. I will also go a little more in more detail in that when we look at the figures. And in line with that, we got our first sustainability rating from EMO with the mark very good. And last but not least, a couple of days ago, we finally connected our up to now largest installation, 2 power plants in Australia, in Leeton, with 14.6 megawatts of combined capacity. We're very proud of that, not only because of the size of the power plant, but also that at the end of the day, we could get it now commissioned in these difficult times in Australia with all the COVID lockdown they are facing right now. Down here, you can see the picture of this power plant. With this in mind, the key parameters that influence our financials, you can see in the first half year, we could grow our electricity generation, which is for us the most important, as we mentioned, in recurring revenue streams. We are generating by 28.6%. We could grow that number compared to the first half year of 2020. That growth comes mainly from the addition in the installed base. As you might have seen in Q1, weather conditions in Q1 were not that favorable. So, however, we could still compensate this by the increase of the capacity that we had in the last 12 months, which was coming from Hungary mainly with 14.1 megawatt. In this electricity generation, Australia, the new power plants are not yet included since they have been commissioned only in August. Therefore, the generation will be seen in the second half of the year. Our proprietary portfolio, as George mentioned, is at the moment at 89.3 megawatt as of today. With these additions in Australia, our O&M business also has grown by these additions now. Otherwise, we are staying at 309 megawatt under management right now. And we have added, and that's also very important to mention, in this first half year now, to our project development pipeline, 187 megawatts, which we continue to develop and hopefully will add to our, then in the next step, invest and add to our proprietary portfolio. Keeping those numbers in mind, how does this affect our financials? If I start with the income statement, in Q2, we could grow our revenues to 9.855 million euros compared to 8.88 million in last year. So this is a material growth of 11% year to year. The main of that comes from electricity generation, which is now accounting for almost 6.9 million compared to 5.9 million a year ago. The other revenues were pretty much the same. As you might know, in Q1 we were lacking behind in other revenues compared to last year, mainly due to lower EPC business. We have compensated that now. Still, we have a little different revenue mix. So we have more technology sales now in Q2 compared to last year, which compensated for some of the EPC that is missing compared to last year. Going into the EBITDA leads us to a little lower EBITDA than last year with 3.898 million euros in Q2 compared to 4.15 million in Q2 last year. This is mainly reflected by this additional costs we have invested in the project development pipeline, as mentioned before, the 187 megawatts. Plus, unfortunately, as we also have communicated to you, that the Australian project, the delay in the connection of the Leeton project we are missing some of the revenues there. This is basically should or could have produced in the first half year almost or should have more than €500,000, which we miss on the revenue side here. However, we still have basically all the costs we had already, or almost all the costs for that we had already. So this is the effect on the EBITDA. Going down to EBIT, we generated 968,000 euros compared to 1.7 million last year, mainly influenced by the lower EBITDA and higher depreciation due to the additional power plants we have connected in Hungary throughout this period, which leads us then to a net result of minus 870 or 69,000 euros compared to 969, so a little lower loss than in the comparable quarter last year. That is mainly due to that we still have a little higher interest cost in the comparing periods due to the higher project financing comparing the periods on the one side. On the other side, we have a positive effect on the revaluation of derivatives, and we also have a less income tax in the comparable period. For us, very important, and this is I cannot mention often enough, is actually the total comprehensive income. As you know, because of our integrated business model we are having from the development to the investment to the construction and then investment into electricity generating assets. The other comprehensive income is very relevant in our company, the revaluation of assets. We have on the bottom line a profit of 505,000 that was influenced in this Q2, mainly due to the investment in Regen, the second financing round, where we have basically the valuation of the asset could be increased due to the higher placement price of the shares that the company could achieve. And on the other side, we also had finally positive, or again, positive effects from the foreign currency translation differences. So the Hungarian forint and the Czech crown, as you might have seen, have developed quite positively compared to the euro. So some of the losses we have shown in Q1 of last year, which put us quite under pressure, have been compensated now, so that year to date, we even could get from a loss of 3.1 million total comprehensive income to a positive total comprehensive income of 2.3 million euros. This is about the income statement. That brings me directly then to the balance sheet. The positive total comprehensive income is one of the contributors to our equity. But first, looking at the balance sheet on the asset side, we could grow our asset base further by about 11.5% to 177 million. That's mainly increase in fixed assets coming from the investment into Regen, but also further development, which we did on the one side, plus also our liquid assets have grown significantly from 14.3 million to 23.4 million, coming from the positive result on the one side, but more from the additional placement of the treasury shares, which I mentioned before, in the amount which we could sell for 7.7 million. That brings us to a equity ratio, or to a total equity of 51.6 million at the moment, so a growth of 28.7%, which gives an equity ratio, the adjusted equity ratio for bondholders right now at 32%, and a full equity ratio of 29%. So we are at the moment very strong on that side. And as we mentioned, we are working with a equity ratio somewhere between 25 and 30% in this corridor. We are optimizing our financing structure. So right now we have a very sound equity for that. Long-term liabilities increased as well by 10% to 114.6 million. That's mainly due to the drawdowns we had in Hungary for the remaining projects we had connected and refinanced already in Q1. This is the balance sheet from a cash flow point of view. When we look at the half year 2021 compared to the 2020 figures, the operating cash flow is negative with 1.6 million. That is not because of the operating business as such, but mainly due to changes in the working capital structure. So we have seasonal in Q2 higher receivables from the electricity generation. We have reduced over proportional compared to last year our liabilities, so that from this point of view we have a negative operating cash flow. From a, let's say, operating result as such, I mean, we had from a net operating loss, still the effect of the operating cash flow would have been clearly positive. The investment cash flow in the same period was growing from 5.9 to 7.7 million euros. That's mainly related to the investment in Regen and the final works in Australia for the project, plus some of the activated project development activities in Europe that we did. Plus also a bigger part here is shown is that some of our liquidity invested or diversified in investment in gold to hedge, basically, respectively secure potential inflation coming. So that's on the investment cash flow. The financing cash flow, we have a very strong positive amount of 15.4 million that relates to on the one side the drawdown on the Hungarian projects in the first half year that we mentioned before, plus the share placement, the 7.7 million, which I mentioned already, which had a very strong effect there, covered by interest payments and the regular repayments on our project financing. This is basically our financial numbers for the second half year and the second quarter, first half year and the second quarter of 2021. And I think now I can see there is a few questions coming.
Well, I think
maybe I hand over to George.
Yes, maybe just to conclude before we address your questions, and thank you very much for them. I think what is very important to mention is that in the last couple of months we have seen, I would say across Europe, but of course we're mainly concerned and focused on the region and the markets where we operate. We have seen a significant increase in electricity prices. I think to a very large degree that's driven by the increase in the price of CO2 certificates, and but we believe there are some additional underlying trends that will sustain the growth of electricity prices. Seems there will be an increase in demand coming from transportation over time. At the same time, some of the existing production capacities will disappear. I mean, clearly, I think it'll be very interesting to see what really happens when the Germans switch off the nuclear power plants. But we see, of course, over the next couple of years, there will be a reduction in coal-fired power plants across the region. We also see that the frequency of them getting offline for maintenance is also increasing. It also partially affects nuclear power plants in Central and Eastern Europe. And clearly also the money printing that's happening will further fuel inflationary pressures, and therefore, I would say, looking at the last 12 months, the value of the projects we develop has gone up tremendously. So our approach going forward will copy the approach we've taken with our 2 power plants in Australia, and it is the base case is we want to sell electricity into the market, ideally on a merchant basis. That means we want to avoid having to sign long-term PPA agreements to get project financing, but we'll try to stay as close as to the market prices as possible by actively managing them. So we're not talking about merchant necessarily forever, but of course there is a lot of space between signing up for a 10-year PPA and a merchant forever approach. So the future is definitely in more proactively managing our revenue streams by signing shorter-term PPAs for parts of the production, sometimes even intra-year, and there from the low point of energy prices during the first lockdown in April 2020, when we saw energy prices of 15, 20, 25 euros per megawatt hour. We've now come to a point where in Hungary and Romania intraday we have prices of 140 and 150 euros, in the evening even 200 euros. Of course, that's maybe not going to be the average price at which we'll be selling in the next couple of years, but definitely the average is a lot higher. When we're developing projects today, as we don't have a feed-in tariff that we can work with, we analyze projects on the basis of levelized cost of energy. That means that we discount the future energy production at the weighted average cost of capital, and of course bearing in mind the existing the upfront investment and the operating costs, which are very low, and basically our LCOE spans somewhere between 45 euros without balancing costs, more like 50 including balancing costs in Romania based on the higher production, so something like 60 euros in Poland. But that already includes basically a cost of capital somewhere between 6%. In the case of Romania, we use 7%. So anything that is above that level just increases our project return, and then of course if we apply leverage, then also our equity return. So with the levels that we're seeing today, and sticking to Poland at the moment, the forward price for peak time electricity for all of 2020 2022 is at, I think today was at 404 zlotys. So we're talking about 85 euros, which is well above our internal LCOE, already providing a 6% project return. And therefore, on that level, we are somewhere at the project return already in the region of 10%. If I look at the prices in Romania and also Hungary, they're even above that level. So it's a little bit like, so this project development, the value of those projects is probably quite comparable to a mining company, and when you value the gold or whatever resource it is in the ground. And I think this shift in, so our this is why particularly today our project development is tremendously important. It gives us control, and it will allow us to create a lot of value by turning these projects into connected assets. And we are of the strong opinion that particularly today, where inflation is becoming a much bigger topic again, and some people think it will go away in 6 months. We'll probably take a different view. We believe that PV plants are actually one of the best inflation hedges that exist. In particular, if we can, if you remain exposed to the price development, and by selling into the market, we also absolutely minimize our credit risk. Therefore, this is of utmost importance, and this is why we are investing a lot of time and resources. The downside of this is always that there's a delay between when we deploy capital into the project development, but also the construction, and when those power plants start generating electricity and therefore revenues and EBITDA. And of course, the EBITDA margin on these on a connected PV plant are 90% plus. We've, I think, seen this now in Australia, where we technically completed the power plants in December last year or early January, but for various local reasons, the commissioning in Australia simply takes a long time. In Hungary, we complete the power plant. 3 days later, the DSO comes, and within an hour, the power plant is connected. So we don't expect these delays in Central Europe, but nevertheless, there's always a delay between the capital deployment, which of course we need to finance somehow. So we incur the costs upfront, and the benefit then comes later. But we'll see a significant acceleration towards our goal of 600 megawatts by year end 2024 in 2022, and that will then also lift us significantly at the top line, at the EBITDA level, but it will also feed through to the bottom line. So the operating leverage that we have in our business at this point in time is very significant, and as we turn that ever-growing pipeline into connected power plants, there will be a significant positive shift throughout our P&L going forward. So I think that's something that was important to say, and so let's move on to your questions. So we'll take it chronologically. So the first question is whether Photon Energy will seek to enter the US market over the longer term, where both solar and storage and water remediation opportunities are significant. We have a tremendous high level of respect with respect to the US market. I mean, we did have some discussions in the past. It is a completely different environment, and a very risky environment. We've also seen over the years that there were several European solar companies that have tried to enter or even entered the US market, and in the vast majority they got a bloody nose. In some cases, it even killed them. So solar is, at least the way we are doing it, it means really with an integrated approach, getting involved in project development, which always is very local, requires a high level of knowledge the permitting processes. And at the end of and it's tremendously competitive. So I think in what I would call the bread and butter business, this is definitely not something that ranks very highly on our expansion list. With respect to remediation, and in particular in relation to PFAS, as I mentioned before, after Australia, North America, and of course in particular the US is a massive market. There's a massive need, and that's definitely a direction we are looking at. I think we can say so much that we have already been approached on the back of the PR that has been surrounding the pilot project with the Australian Department of Defense. The US Department of Defense has a much bigger issue. There's about 800 Air Force bases, US Air Force bases, that have, in some cases, unbelievably high contamination levels with PFAS. The Pentagon in 2020 actually created a $2.1 billion budget to start looking for solutions for this problem. So it is something that's being taken very seriously. However, we want to wait for the results of the progress with our Australian project, then possibly also some additional projects, maybe from other non-governmental customers. But clearly, the US is very interesting. So, and with this specific solution that we have, and once we have the validation from this pilot project, it is definitely something we'll look at very seriously. We have had some preliminary discussions, but we will wait for the results. So in that respect, so if US or North America, then definitely in that area. The second question is whether we can estimate and quantify the financial impact of the commissioning of the Australian projects, whether the bottom line will go positive in Q3, Q4, and what the results in H1 would have been without Australia.
Well, maybe I can, as mentioned before, to start from the bottom. It's not a question about what the results would be without Australia, more like how much we would expected additional revenues there. So the plan would have been that about 500,000 to 600,000 euros in the first half year would have been generated already. The capacity of the power plant is about some 29 gigawatt hours per year that we can generate. So it's quite significant, depending on as you know, we go merchant in that project. So we sell electricity and the certificates, the green certificates, the large scale certificates we generate there on the market. Expected revenue annual is somewhere, given the current market environment, at about 1.5 million euros, or less 1.3 to 1.5 million euros that it can generate. So that's the impact we will see in the future from that as a positive addition to our portfolio and in our income statement. When we look about the result as such, here again to emphasize the bottom line, which is for us total comprehensive income, is positive in the company. So we have generated a positive contribution to the company, to the equity in total comprehensive income. We clearly see that going forward also for Q3 and Q4, considering the expected development in our forecasts. However, we are not making concrete forward-looking statements, so sorry for not being more concrete here, since it's a company policy.
I think what we can say is that, of course, given that the majority of our revenues are from energy generation, and despite this latest addition in Australia, the vast majority of our production capacity is in Europe, and it's seasonal. Q2, Q3 are the strongest, and then Q4 and Q1 are rather weaker. So that will remain in place.
We expect, as mentioned, what we lost or what we are missing in the first half year in Australia, we expect to add in the second half year now roughly And as George said, Q3 is going to be traditionally very strong. If you look in our history and compare the quarter by quarter, electricity generation roughly is 35% in Q3 and Q2 each, and about 15% in Q4 and Q1. Australia will be a little the other way around, so Q4 will be strong in Australia and then Q3. Since there the summer is starting. That's about this. And then maybe also one question regarding the cash flow, about if you expect the operating cash flow in second half year will be positive. Generally also the quick answer is yes. We expect that generally our operating cash flow, and you also, if you look into our history over the last couple of years, the operating cash flow of the company is positive. As mentioned now in the half year figures for 21, the operating cash flow shows negative only from the changes in the working capital. So by basically seasonal in Q2, especially increase of receivables, which is from electricity generation and which naturally always get paid. And on the other side, we have extraordinary high repayments of liabilities, of payables, compared to other periods in the past, which also had a negative impact on the operating cash flow as such. The operating result, if you look in the EBITDA, or basically roughly coming from EBITDA more or less, is clearly and strongly positive.
Okay.
Maybe about
so we skipped one question, which is whether commissioning of first capacities in Romania in 2021 is still feasible. The way it looks now is we will have projects that will be ready to build by the end of the third quarter, Q4. But the way it stands now, and it is mainly linked to the procurement. So I think this much is also worth adding. What we do see is not only an increase in the prices of certain components, mainly linked to the increase in prices of the raw materials. So this is the mounting structures and transformers, which use a lot of metals, steel, and copper. So those prices have gone up. But what has also happened is that the lead times have become significantly longer, and it's also it's a very unusual situation in the sense that when we get price offers, they're often valid only for a couple of hours or 1 or 2 days maximum. So this increase in lead times is leading us to most likely postponing the construction of those projects that will be ready from a regulatory or permitting point of view. So there will be some pent up. So we expect there will be quite a lot of pent up, or they will start the construction of several projects in Romania, in particular, ones where weather permits after the winters. We are probably talking early March. So at the moment, most likely that whatever we have ready will get pushed into the first quarter next year, and this is mainly the result of these procurement issues. We are going to build at least 2 power plants, maybe a third one, should do in Hungary before the end of the year. The procurement has been done, but we will probably over the next couple of weeks we'll do certain strategic, let's call them strategic procurement steps for next year, given the volume of projects that we want to execute next year. And clearly, Romania will be a hotspot next year, and I guess that this will be the most active market for us next year for construction for our portfolio. So the next question is whether you are already able to take advantage of increased electricity prices and sell some of the electricity generated in Hungary above meta prices. Well, the issue is that I mean, it would be lovely. Those meta, meta, however, is a contract to difference with essentially the Hungarian government. So the meta price at the moment in euros, we're somewhere around 95 euros. The billing is on a monthly basis. So now there have been days where we've been able to sell, and my hunch is that this month we will be across, on average, across the line, we will actually have generated more than the 95 euros in the market. And simply as contracts for differences go, that excess we will have to send to the Hungarian government. So the answer is unfortunately no. However, as I said, the two projects that we will still build, at least this year in Hungary, and then also what will follow next year, will all be based on market prices. So we'll probably build them off our balance sheet, at least the first couple of megawatts, and then refinance and we'll connect them, start selling, and then we'll see how we deal with the financing. One of the two projects we're building this year actually won the auction. The first auction, there we have a price of around 70 euros, which is of course below the market price. On the other hand, it's highly bankable, so we'll stick to that meta arrangement. It's basically also a contract for difference, just like the old metas or the system that's in place with the auctions in Poland. So that project will be running on a 70 euro meta, and it makes sense because of the high level of bankability. Here, I would like to point out that just yesterday we got the results of the latest, I think it was in total the third auction in Hungary, where the winning bids on the large projects. So this project that we will realize is 1 megawatt AC. But I looked yesterday at the prices for the larger projects up to 20 megawatts, and the winning bids were below 50 euros per megawatt hour. Given where the market is today, from our point of view, it makes no sense. I think it's going to be great for the Hungarian market government, because they'll be basically getting all this access. But and I think the last couple of months have validated our approach. We believe it makes no sense to develop projects and submit them to the auctions both in Hungary and Poland. And the market-based approach is the way to go. And we also believe that the banks that finance PV projects are also starting to recognize the validity of that approach. The first step for them will be to finance projects that have, or finance projects more easily that have longer-term PPAs. But we also see kind of the first signs that they'll also be getting more and more interested in projects that have, if not the full merchant approach, at least something that's very close to it. And currently we are working on financing models where we can get the more courageous banks on board, but at the same time make sure that we can capture as much as the upside from current levels and what we believe will be a positive market price trajectory in the medium to long term.
Good. I think then we are.
If there are any more questions? No.
Time-wise, we're already a little over time.
So we would like to
thank you for staying.
Thank you very much for your attention and for your interest. Of course, our IR department is always reachable with additional questions that you may have. And of course, we're looking forward to providing some positive news in the next 3 months until our next presentation. And of course, we also hope that next time we'll be able to report a lot of progress and positive numbers. So thank you very much, and we wish you a nice rest of the day.
Thank you very much. Goodbye.